Well, last night was an exceptionally busy night for people who watch the financial industry. On the one hand, you have the Fed coming out and describing to the market what the how the banks did in their stress tests, and then the banks responding by saying how much capital they're raising. So on that front, JPMorgan looked like it was able to raise even more capital than a lot of analysts were expecting.
Sure.
Or not raise, but pay out a lot more capital than analysts were expecting. On the other hand, the Senate subcommittee is saying, look at all these risk management weaknesses within this bank, and look at what they allowed to happen, and look at how they tried to mislead investors and regulators about what was happening. So as an investor, the question might be, do I just trust this management team to keep paying me out and not worry too much about what's behind the curtain? Or do I what comes across in the Senate report is, if you're an investor, good luck knowing what's going on behind the scenes.
Christine Harper will go through this in the hour. So much to talk about. And, of course, we'll go up to the 9:30 hearing this morning. Scarlett, you've got much more on this.
Well, the Senate committee went through 9 months. They took their time really investigating this trading loss, the London oil trading loss. 9 months of investigation, a 301-page report. And the conclusion was pretty stark, that Jamie Dimon, JPMorgan, under Jamie Dimon, ignored limits on risk-taking, hid losses, dodged oversight, misinformed the public. This is definitely going to bring back to the table all that discussion about whether big banks need to be broken up, whether Jamie Dimon should still be chairman and CEO of the bank, whether that role needs to be split up. I mean, it renews those calls, doesn't it? It
does, and it also renews calls about, just the question of can banks of this size and complexity be managed effectively? When the bank finally announced in May of last year that they had lost money on these trade, or it expected to lose money on the trading positions, having dismissed it a month earlier as a tempest in a teapot, the question was, did they just not really know what was happening in April, or has something changed dramatically, or were they misinforming people? And what comes out in the Senate report is actually they did know it was pretty bad, and they kind of tried to cover it up, and that's not a very good
Eric
outcome.
Shasker alluded to that earlier, but this divide between Sally Krawcheck and David Hilder saying, forget about it, let's move forward, and a lot in the media saying, no, let's look back. How do we parse those two worlds? Our viewers and listeners, their heads have to be spinning.
Well, I think investors will take different views. I mean, a lot of investors will be comfortable with, Jamie Dimon, I can trust him, he's done a good job, this is a minor blip, and we can move on.
Yeah.
On the other hand, we were in Davos, we saw that panel where Paul Singer at Elliott Management challenged Jamie Dimon about the opacity and complexity of the banks, and how, as an investor, he didn't feel he had the information he would need to invest in a bank like JPMorgan, because they're so complex.
Amazing.
Well, and Christine Harper, you alluded to the stress test, but I just want to hammer this just one more time, because it was a double whammy for JPMorgan last night. JPMorgan and Goldman Sachs were allowed to return cash to shareholders, but it was on a condition. It was sort of a yellow light signal here, and they cited weakness, and the Fed told JPMorgan and Goldman Sachs, come back to us when you revisit some of the weakness in immediate.
What translate that for us? You're the pro here.
Well, first of all, that was a huge surprise, because the market sees JPMorgan and Goldman generically as sort of some of the most successful banks
and best
at this juncture. So, and neither of them have had any problem with stress tests up to this point. So the expectation was they'd sail through, as they have. And so for the Fed to basically say, okay, we'll let you pay investors what you've decided to pay them, but there's something wrong with how you're doing this.
Do we know what that wrong is?
We don't. It has something to do with the way that they plan, the process behind the scenes. What's interesting about those two banks, of course, is that they're the biggest trading shops. They make the most money from trading. So possibly it has something to do with how they're modeling the risk of their trading portfolio.
Or even mark to market.
Exactly.